everyone, and welcome back. I hope you are able to grasp a lot in understanding how you will make your money, because now we're going to get into what we actually trade. In this lesson, you'll learn actual currencies and the breakdown of majors, minors, and exotics. And we'll also go in depth with when you need to trade, because not all trading hours are good. So again, definitely take notes and use the list of bullet points to help guide you through this lesson. So the question: what do you trade? The simple answer to that question is money, but you're not actually holding anything physical. The best way to describe this is when you're looking at it from a virtual perspective and virtual money. So essentially what you're doing is buying and selling shares in a different economy. You're trading one currency for another, which is where we come into the conversation of exchange, because you're literally exchanging one country's currency for another country's currency. There will always be a base and a quote in currency, with one currency being quoted against another. For example, GBP is the official currency code for the Great British Pound. USD is the currency code for US dollar. GBP USD means the Great British Pound value is being quoted against the US dollar value. A currency pair always quotes the value of any two currency pairs together. Now, there are various currencies all around the world, but I'm only going to name the major currencies first. We already talked about the US dollar and the Great British Pound, but you also have the euro, the Japanese yen, the Australian dollar, the Czech franc, the New Zealand dollar, the Canadian dollar, and these are the major currencies in the market. One thing we have to take into account is how healthy that particular country's economy is. The more healthy an economy is, the better it is for that country's currency. So we talked about supply and demand in the last section, but there's an abundance of things that affects the economy, which really boils down to geopolitical factors. We'll get into that in our later lessons. So earlier we talked about major currency pairs, which are the countries that play a main role in the foreign exchange market, but there's also something called majors, which is completely different from major currency pairs. Majors are any pair that contains the US dollar. These are called majors because the US dollar is the most widely traded currency in the world. It is also the most liquid and traded at the highest volume. So major pairs are pairs like AUD USD, NZD USD, Euro USD, USD JPY, GBP USD, USD Czech franc, and USD CAD. Now, the minors are any pairs that do not contain the US dollar, but the most widely traded currencies like the Japanese yen, the Great British Pound, the euro. So we have GBP JPY, GBP AUD, Euro JPY, etc. These are not considered majors because the majors have to have the US dollar in them, but they're still widely traded currencies against one another. Another category are currency pairs called exotics. These are any major currency that is paired with a developing economy. So they're not heavily traded, but there's still a lot of revenue that can generate from these pairs, like the Mexican peso, the Indian rupee, the South African rand, the Singapore dollar, and the Hong Kong dollar. So in trading, there's always an agreement that has to occur. Anytime there's a buyer, there always has to be a seller. So when you place a trade somewhere in the world, there is also someone else in the world placing a trade in the opposite direction. This is where your broker comes into play. The broker is brokering the deal. So they're finding a buyer and a seller in order to place that actual trade. So how do you make money in this market? I'm going to equate it to real estate. So let's say you buy a piece of property and you fix it up. Then you hold on to it for a little while and you renovate that property. And once it's finished, you turn around and sell it for a higher price. The foreign exchange market is literally the exact same thing, but you buy into a currency and you hold your price and you're holding your position, understanding that the exchange rate between the two currencies that you have bought is going to fluctuate, and ultimately the value you're going to be making is going to be the differentiation in the value that will give you your profit. So when you buy a currency, of course, the goal is to buy low and sell high. So you're buying into an economy with the understanding that the exchange rate will go up. You hold on to it, and when the demand goes up, you sell it. Now, the beautiful thing about trading when it comes to real estate is you have to have an extreme amount of capital in real estate. But once you understand the skill set of trading, the trading in the foreign exchange market, you're able to see when there will be certain fluctuations in the market that you can capitalize off of. So you buy a currency when it's low, you sell it when it's high. Now, the amazing thing about it is you make money whether the price goes up or down. So if the price goes down, then you're selling it. However, you aren't selling your money, you're selling your position, and you're making a profit from the position that's currently being sold. So Now the question is, when do you trade? In order to trade in the foreign exchange market, it's very important to understand when you trade, because technically the market's open 24/7 from 5 p.m. Eastern Standard Time on Sunday to 5 p.m. Eastern Standard Time on Friday. However, although the market is open during all these hours, that doesn't necessarily mean you need to take a trade any hour of the day. There are actually 4 trading sessions that you should be aware of: the Sydney session, the Tokyo session, the London session, and the New York session. So when the market opens Sunday at 5 p.m. Eastern Standard Time, Australia and New Zealand people are just starting their day, which is technically 8 a.m. Monday morning their time. That session is then overlapped by the Tokyo session starting at 8 p.m. Eastern Standard Time. Then the London session, which is 3 a.m. Eastern Standard Time, then transitioning to our actual opening of the New York session at 8 a.m. Eastern Standard Time Monday morning. In regards to liquidity and the best time available to extract money from the market, I would say London session and New York session are the best because they are the big movers in the economy. London session is made up of the pound, the euro, the Czech franc, and the most active trading session during this time. There is high liquidity, high volume, lower spreads, and major news releases. The US dollar and the Canadian pairs moved during New York session, and because over 80% of trades involve the US dollar, New York session is a highly traded session, and the volatility typically ends around noon. Sydney and Tokyo sessions are the slowest sessions because the Australian dollar and the New Zealand dollar are the calmest markets. And during Tokyo session, liquidity is typically low due to limited activity, resulting in higher spreads. Now, just because the session moves slower doesn't necessarily mean that's a bad thing, especially if you're new to trading, because that means that big swings aren't necessarily there, as well as aggressive volatility. So I would say whatever particular trading session that you trade, it should definitely correlate with the actual pair that you're trading. Now that we've gone over what we trade and when's the best time to place these trades, make sure you revisit and do your due diligence in taking notes, because this was a very important session and we'll be doing a lot of the basis of our actual knowledge around this session. So with that being said, I hope you enjoy the video and see you in the next session.